Hey guys, this is Damon Varial, and I was in the process of creating or planning a new course for you guys. Right now, the most recent course is Gap Game Plan 2.0. I am currently responding to requests for an options course by planning that options course. But I also have requests for people who want to get into day trading as a part-time type of thing. So I'm going to tell you in this video about how I do part-time day trading, and you guys can give me your feedback as to something that you'd be interested in seeing as a course. So let's just go into the basics of what part-time day trading is, because people have different conceptions. When people think of part-time day trading, they think of maybe they can make a couple days worth of day trades, maybe take a day off of work and do this type of up and down candlestick trading, which is possible, but that's not what I consider part-time day trading. And if I were to make a course, it would not be on this type of intraday trading. I call it intraday trading. Now, intraday trading is what most people think of as day trading. It's using whatever indicators during the day. So right now we're looking at 15-minute candlesticks, and each of these is one day, and basing your long and short positions on those indicators. I've done this before. I don't find there to be enough movement within a single day, especially if you're just trying to get in for 1 hour or so. For most people to play, unless you're using options, which is okay, but still, the lack of relative volatility during the day means it's hard to make significant profits unless you already have a lot of money that you're going to put into your day trading. So when I talk about part-time day trading, I talk about making at maximum 2 trades per day, and those are at specific points. This type of day trading can be done by people who have jobs, as long as you're available to make a trade at the beginning of the market and the end of the market. So market open at 8:30 and then market close at 4 o'clock. Is it 8:30 or 9:30? I'm on Tokyo time, so I'm not really sure. But what you need to do is be able to trade at those 2 times, and then you can use my part-time day trading method. So what is it that I use? Well, like I said, if you don't have a lot of money to put into short-term trades, you generally cannot make large profits. So I use options to give myself a form of leverage. I buy a weekly option that's far in the money, or multiple weekly options that's far in the money. You could look at options here. You can see the delta of those options. This is important because it tells you how you're mimicking that stock. So let's say we're looking at the weekly options for, I got a LLL example queued up, so we're going to do that. Let's say we're looking at the weekly, well, LLL doesn't have weekly, so let's go back to First Solar. So let's say you're doing a weekly option on First Solar and you think it's going to go down. You're going to be looking at the puts. You're going to hopefully play something that's in the money, and you do it with an option that has at least a decent amount or some volume and a decent amount of open interest. And here we see the best option to play for that weekly is with a delta of 668. What that means is you're mimicking shorting 67, rounding up, shares of First Solar. So that is my tool, a in-the-money option or multiple in-the-money options. Now, how do I use it? Well, like I said, timing is important. We're looking at trading at the beginning of the day and at the end of the day. So essentially, we're holding for the entire day, but not just that. We're also buying sometimes at the end of the day and then selling at the beginning of the day. So we're also playing the overnight gap. And I'll show you what that means right here. It's pretty easy once you get the hang of it, and you can see that it's pretty profitable if you pick the right stocks. So I'm going to just pull down this 7-day chart. Each of these candlesticks reflects 1 day. Now, we're playing 1 day, right? So what we're seeing is the daily movement upward, and we're capturing all that. So say we bought a long call at market open and we held it all day. we would have made profit on this one. And if our option was delta of 67, like we said, the what do we got here? We got about 60-cent movements, right? So let's do the calculation and see how much we would have made on one option contract. 67 cents movement and 67 delta. So that's 44.89. We would have made about $44 on that trade. Now, if you're buying a lot more options, this can become a stable income as long as your strategy works over time. We're always trying to play the law of large numbers so that our losses don't really matter as long as we're making more over the long run. All right, so let's go back to this monthly chart. What is it we're doing here? Well, if we're buying it open and holding all day long and then selling at the end of the day, we're getting whatever gain we see from the bottom of the candlestick to the top of the candlestick, not including the shadows. So if, for example, and here's the key, if, for example, we know a stock will show a green candlestick or a red candlestick under certain circumstances, then the law of large numbers is going to be in our favor, provided that the candlestick size is also going to be significantly significant in terms of versus the other candlestick, the red candlestick, for example. So I have written an algorithm that calculates this type of stuff. And exactly what I'm doing is I'm looking for stocks that have clear patterns of their candlesticks and or of the gaps between candlesticks. Remember, buying at the end of the day and then selling at the open could also get us a significant movement if we can predict a significant gap. So in this case, we see that the next day after this day, the stock opened at 32. So that's almost, that's about $150 profit on a call option held overnight, which is pretty cool because essentially you weren't exposed to any movement of the stock at all. You didn't actually see the movement. You just sold it because after you woke up, it was just worth more money. Now, we can predict that kind of stuff because some stocks have clear patterns. For example, this algorithm that I have written and run gives me a number of values. For example, the probability that the candlestick will be white if the stock opens higher. So here I see it's not significant, but once in a while we get something pretty good. I wouldn't even play this even though it's 60%, but let's just look at that for an example on LLL. So it's the probability that the stock gives us a white candlestick if the stock opens lower. So if we see, for example, here, the opening is lower than yesterday's close, then with a 59% chance, the candlestick on this day is going to be green. So you would buy at the beginning of the market, you buy at market open and sell at market close, and over the long run, 60% of your trades would be profitable. But that's not enough because sometimes a stock has small green candlesticks but big red candlesticks, and that's a characteristic of a specific stock. If that's the case, we need to integrate that into our algorithm. So we need to calculate how much it's worth. We also need to calculate, in a sense, the size of the candlesticks of each color and also the size of the gap. If we know all that information and we find statistically significant patterns for certain stocks, we can play it quite, we could play to where we have a decent accuracy and expectations of how much we're to make. And if you've ever seen that video on me trading the nugget, where in one day I took $3,000 and made it over $10,000, I was using this process. I don't trade the nugget now because I update this algorithm with the most recent data, and if the data shows that the pattern has stopped working, it's failed, we don't trade that anymore. We keep searching for something else. So there's a time, I believe it was last fall, that the nugget had a very strong pattern that allowed me to predict its movements with something like 70 to 80% accuracy, and that's how I got my account tripled in a single week. So when we find a pattern like that, we want to play it. And doing so means we also have to consider the upside and downside, so that's the size of the candlesticks. And we also have to consider the theta value, because on a weekly option, remember we looked at delta, which tells us how many shares of stock we're mimicking holding in the case of calls and shorting in the case of puts. But this theta value is also important because it tells you the daily loss of the option, all things being equal. So in this instance, we're losing $8 for each contract that we hold open during the day. So when we're trading those candlesticks, not the gaps, when we're trading the daily candlesticks, we buy it open, sell it close, we also have to incorporate this automatic loss. So the tides are basically against us. If we're playing 50-50 stocks, we're actually losing, because you can think of this as the casino fee or whatever that you're paying. So you need to make sure that the probability model overrides this cost. And that's what I do down here in my algorithm. I check the theta value that's going to be worth it. If we find that a theta value, for example, if it says theta is 0.196 or 0.0196, we can play any option that's going to be less than that. We don't want our theta eating up all of our profits and more. So you'd look at, for example, this one, theta low. We have a really high theta value. So that's the theta we're willing to take on if we play this. So if we're playing when the stock opens low, if we have a strategy that is allowing us to predict what color the candlestick will be during the day, and the profitability according to the algorithm is high enough to where we can take on a high theta option, that's pretty playable. And that's generally what I use to determine how and what stock I'm going to play. So I hope this has given you a pretty good example. You could actually swing trade and reduce commissions by about 50% by using this method. Remember, day traders, they have high commissions to overcome because they're selling and buying multiple times during the day. What we're doing is we're finding a stock that's worth playing because it has strong patterns and is worth playing for more than just one day. It's worth playing, for example, for a month. And if that's the case, we can reduce commissions by swing trading. What I mean here is, let's say we buy a put option, we hold it throughout the day, and then we see that the next day, according to our algorithm, is probably going to give us a down gap. We keep holding on to that put. Now, the next day it opens low. If our algorithm says open low gives us, a significant probability of like 70%, that the candlesticks could be red, we continue holding. And then if we see on the next day it opens higher, what we could do is we can swing trade, because if our algorithm says open high equals green candlestick, we swing trade by closing that put position and at the same time opening a call position. That's done as one order entry, so we only pay commission once. Most day traders would be closing this and then waiting for the next opening time and then opening this. That's going to cost them 2 commissions. In contrast, we're paying commissions once. Now, you can make this entire strategy a bit more complicated, a bit more complex by looking at things like the historical seasonal patterns of the stock, the historical seasonal patterns of the stock market in general, and we can trade with the rising tide or with the lowering tide so that our decisions have higher probabilities associated with them. You can make it as complex as you want. You can make it as easy as you want. If you do have time at the beginning of the market and at the close of the market, let's say you have shorter 9 to 5 days, you might have like a 10 to 4, which would be great. You can really not put much time at all into your trading and still come out with a decent profit because you're using a probability model that doesn't require you to actively watch the market. So hopefully this has been helpful. If there's enough interest in a course on this, I'm more than happy to put it together. If I don't get enough interest on a part-time day trading course, what I'll do is I'll put out that options course first, because people have been asking for that for quite a while. Like always, give me your feedback and opinions in the comments section. It really helps me a lot to decide my content plan moving forward. And yeah, that's it. If you got questions, leave them. Love you guys.